All right, in this video, I wanted to talk about a mistake I made with a Tesla call spread. So, a little over a month ago, I sold a put spread for earnings on Tesla. It was a 220, 215 put spread. Tesla fell after earnings and fell below 220 the following days. And then when it reached my break even, which is around 214, I decided to sell a call spread at 220 to 25, which you could see over here. This call spread over here, November 17 expiry. Now, the mistake I made is Tesla, after I sold my call spread on Tesla to mitigate my existing put spread, which was at around 220. So my put spread was at 220. Stock dropped below 215, 214. So I sold a call spread at 220, 225, creating an iron condor with my existing, or not an iron condor, but an iron butterfly with my existing put spread. Collected $1 from the put spread and $2 from the call spread. So total credits is $3. Max loss would be $2 because the width of the spread is $5. So 5 minus 3 is $2. So max loss would be $2. So the mistake I made is Tesla continued to drop. It went all the way down to 190, and I think even in the 180s. And my call spread that I sold for mitigation purposes was more than 75% profitable. It was trading at 50 cents or even 40 cents, and I just didn't notice it. I should have definitely closed it. I mean, when it's that much profitable, there's no point keeping it. Now, guess what happened? Tesla ended up recovering before my expiry of November 17, and it was way above 225. So now my call spread that I had initially sold for mitigation purposes that was completely profitable or more than 75% profitable, I didn't close just because I wasn't paying attention, and it ended up being the reason for the trade being a loser because as you could see here, the call spread that I sold for mitigation, I ended up closing it for $5. So basically, this mistake of not closing my profitable call spread ended up costing me about $450 because I could have bought it for 50 cents. Instead, I had to buy it for $5, so $500. And my initial put spread that I had sold for earnings, which was completely breached, ended up being a winner. I was able to close it for 18 cents, and it would have expired worthless if I just held on to it. So once again, this is not the first time this happens. Once again, when I sell a call spread to mitigate a put spread that gets breached, the put spread ends up a winner, and the call spread ends up the reason why the trade is a loser. But at the same time, it's hard not to do anything when you see your put spread completely breached. In theory, you should trust your existing trade and just let the probabilities play out, but it's hard not to do anything, and you want to mitigate your existing trade and sell something to reduce max loss. And I could have sold a call spread at a different strike, maybe not exactly at the same strike as the put spread, but I don't like making several trades and gradually bringing the call spread closer to mitigate. I'd rather just sell the call spread that gives me the biggest credit because right now I'm trying to save a losing trade. I'm not trying to win on the trade. But definitely, once again, the mistake was that $2 call spread that I sold for mitigation was eventually worth 50 cents. I didn't notice, and it ended up costing me $450 because I had to close it for $5. Now, moving forward, what could I have done? I guess I could have placed a limit order, a good till canceled limit order, so that the trade closes on its own, even if I'm not watching the market. But I really didn't expect that to happen, to be honest, and that's probably why I didn't place the order. I did eventually, when Tesla continued to drop, I did sell two put spreads lower than this existing put spread of 220, 215. I think I sold at 190 and I sold another one a bit lower, but I did close them for a profit, but for a very small profit. So they don't really make up for this loss, but I sold it in my Interactive Brokers account. Referral link in the description below the video, by the way. But now seeing that Tesla flew today, I didn't even notice it. Actually, let's see if it flew at the end of the day. Yeah, that's why. Yeah, in the morning it didn't fly, but it flew midday. Now that it's flying, I'm probably gonna sell a call spread against it. Yeah, although I'm not doing well with call spreads, they always end up getting breached. Maybe I should buy a call spread. If I keep losing on selling call spreads, maybe I should buy call spreads in that case. Still hard to do. Yeah, I might sell a call spread a little bit higher. Actually, let's see what the options are trading for on Tesla. So let's say I go 30 days out. So December 29 would be 31 days. 245, 246. So we could see, yeah, the straddle is about 25 points. Yeah, it's not that much, but let's say, so extended hours 250. Tesla's at 250. So 245 plus 25 is what, 270. So I would sell a call spread at 270 for December 29. Let's see what that gives me. So 270 short call and then 275 long call would give me almost $1. Yeah, that's what I usually try to collect. So if I think Tesla stays below 270 by December 29th, well, actually I don't know anything. This is just me assuming that if a stock goes up hard, eventually it's going to recover a little bit. So I'm going out of the money. It went up already to 250 while it was trading at 235. I mean, the low of the day was 234. After hours is 250 without any earnings, and I'm giving it some room to still go up a little bit. I'm selling the short strike of 270, so it can go anywhere from 250 to 270, and the trade will still be a winner as long as it doesn't go to above 275 by December 29. That's the plan. It is very possible, but I mean that's the plan behind the trade. So estimated earnings is January 24th. Yeah, I think I will do that tomorrow if Tesla's still at this price. Maybe even go to 275, 280 if Tesla's at 250 after, in the morning. All right, just wanted to share with you my mistake with this Tesla call spread. Hope you learned something. Thanks for watching.